So the question to you is, how can stocks continue to rise in an environment where the equity risk premium is so low and the risk-free rate is so high?
So I'm going to say I don't really give a toss about any of that stuff, but I'm saying the name of the game is to find a great company. Mm-hmm. That kind of thing is, you can wrap yourself up in all that macro stuff, and it's, again, if you're on Nvidia, who cares?
Yeah. So that's the answer to Greg. If you're watching it, Callum doesn't give a toss. Hello and a warm welcome to What's Not Priced In, or as our next guest called it, The Price is Right. Now, this is the podcast that asks the most important question in investing: what is the market currently not pricing in? But before we begin, a couple of things. Obviously, we're in studio, and another thing is that's not Greg, but it is the esteemed Callum Newman. Callum, welcome to the show.
Thank you for having me.
Introduce yourself.
I'm Callum Newman. I'm the editor of Australian Small Cap Investigator and the trading service Small Cap Systems. So I specialise in the small cap sector here at Fat Tail Investment Research.
Nice. Now, Greg is obviously away. He will be back next week, but we did want to have you on the show today. And a few weeks ago, Greg described you as the most positive man in finance, or Mr. Positive. So I think this episode is all about why you hold the optimistic view of the markets, and maybe why the markets may be a little bit too pessimistic, and why that is. So maybe I'll read through some of your recent quotes that you've written in Livewire and obviously elsewhere. And these are very, very positive quotes. So you've said, there are so many reasons to be positive going into 2024 and 2025. Misery might love company, but it rarely generates profits. Optimism pays, at least in my experience. All the ingredients are there for the Aussie stock market to start firing on all cylinders. All-time highs should peak in 2024. So obviously the biggest question people would have is, why are you so positive? And plead your case.
Oh, absolutely. Well, let's go back a bit. And remember, I've been doing this a long time now. I've been here at Fat Tail for 12 years. So I've seen a few things go around once or twice. I remember back in 2021, people watching this may have been involved in the market was absolutely booming, right? The small cap sector was going bananas. And a lot of that was rank speculation and, just crazy momentum and people piling in, right? All that started to break down in about August 2021. And around that time, I started to become a little bit cautious, because what was happening was a company would release good news and it would sort of sell off. And around about that time, the China property issues flared up again, and the small caps started to go down before the bigger stocks that came later in 2022. So ever since then, it's been a grind in the small cap sector, actually. There's definitely been opportunities, but relative to how strong the sector can be and the alpha you can generate there, the last 2 years has been tough. So I've been watching that the whole time. And but to put it in context, you've got to remember last year the market were very worried that the US would go into recession. Nobody knew where interest rates were going to peak out at. Oil spiked up for a while, we had Ukraine and all that type of thing. So lots of pressure on the markets, and it got very volatile and difficult there in the big cap space as well. But a lot of those issues are fading away, but the small cap sector is still dragging its feet. It's still down in the dumps relative to the way I've seen it in the past. And you have a bunch of really good companies, solid companies, trading very cheaply. And we only need things to turn a little bit better, and they're going to start moving up at some point. And I think you can get a really good ride for the next couple of years on some of this stuff. And if it goes the way history suggests it might, it's going to be a really exciting couple of years coming up. So that's just a taste of what I'm seeing. But other reasons, the market has been dominated by macro concerns in the last couple of years. So with interest rates peaking, that's in sight now. Inflation settling down. The US not in recession and actually looking pretty strong. China stimulating. Well, what more do you want?
Nice. And I think also there may be a misconception with small caps for some investors that they are all narrative stocks, they're all growth stocks that might not necessarily be profitable, but there are definitely stocks out there who are generating profits that are flying under the radar, maybe a bit undervalued. So it's not like small caps are just story stocks that maybe buy now, pay later 2 years, 3 years ago.
Yeah, or cannabis in the year before that, the years before that, and there's all these thematics that come through. But yeah, so with small caps, you have a broad suite of stuff. You have stocks that don't make money, some that don't make revenue, and ones that do make money and are actually very well established and run by teams that have been doing it a long time. So you can be as conservative or risky as you like.
And which range of the small cap sector do you usually focus on? Sort of profitable companies, or do you also maybe take some bets on?
I do. I would say I do have a bias to companies that have cash flow, especially at the moment, because I feel that the market is just not chasing those kind of growth stories where they will forgive the losses and the cash burn and that type of thing in more genteel times, we might say. But definitely at the moment. But I do also have because I always look down as well, and I want to make sure that I'm not going to get ripped out from underneath me, which can also happen in the small cap space. So, if I can get a look at some juicy cash flows and a reason to think something's going to push up the share price, I'm all over it.
Yeah. I think also the markets have been bad, but there have been some gems. I think the biggest one recently, I'm not sure if you've followed this, was Pro Medicus.
Oh, yeah, absolutely.
It's taken off consistently for years now, and that's just been a standout performer. But so you've sort of outlined your case, and we've got a lot of topics to get through. I want to ask you about iron ore and other type of things, and we'll also get maybe a bit of your insight on a few stocks that you're liking at the moment. But I think now maybe I'll introduce a bit of a counter argument. Obviously, Greg isn't here today. He did sort of send me some questions he wanted to ask, or in his words, to grill you on.
Okay.
And I think this sort of ties in nicely into the latest macroeconomic results that have come in. So I'll just briefly mention. You don't have to comment on it too much right now. But obviously, headline monthly inflation came down. And that's probably, in your view, a good take. But I wanted to get your view on the retail sales. Retail sales came in much softer than expected. The market wasn't really expecting such a decline. They actually fell 0.2%. Market expected a 0.2% gain. And annual sales growth actually slowed to just 1.2%. With population growth, if you take in population growth running about 2.4% a year, retail price inflation ran about 3.6% a year in the September quarter. So it's actually a large per capita decline in retail sales. So what would you say to those people who are saying, look, maybe there are some undervalued stocks in the small cap sector, but the economy isn't really improving, it's actually worsening?
Well, that's true if the statistics, but I would argue that that's priced in by the retail stocks already. So a lot of them are, again, this has been going on since 2021. So a lot of them are heavily down, and you can actually start to look and start to think and go the other way. At some point, the market's going to go, well, it's going to look through the downturn that it's priced in and look to the other side. We've already had a taste of that. So it's funny you mentioned retail. So Temple and Webster, which is online, came out with their sales, and their revenue's going through the roof, and the stock's taken off like a rocket in the last couple of days. So again,
and even with Harvey Norman, it said the results were down, but the stock went up. So I think the market already priced that in quite heavily.
Yeah, and there's another stock called Cettire, which had a ripping run earlier in the year. So even though in a broad brushstroke you can go, retail, it's a disaster or whatever, it's down in the dumps, there are specific stories in there that can still do well, which is true of any sector at any time. So the macro, the broad brush can lead you astray sometimes. And I remember watching that Cettire one, and I got sort of sucked in like, retail, I'm not so sure. And bang, the thing took off like a rocket. So luxury sales generally around the world are holding up. So there are niches that can do well, but all the stuff that you've just alluded to, I would argue is already priced in, and you have to start thinking about looking to the years in the future where which companies are going to come through the downturn stronger on the other side.
Yep. And yeah, definitely I had Temple and Webster here as well, and Harvey Norman. I think another one so maybe a question from then is basically, as a small cap investor, do you pay any attention to macroeconomic stuff like retail sales or inflation data or business credit growth or anything like that?
Oh yeah, absolutely. So you have your general view of the market and the world and that type of thing. And then you look at individual stock stories. So as again, the market has been very macro dominated in the last couple of years. So absolutely you have to pay attention to those things. And I think one thing that's holding the Aussie market back is the rate question, the interest rates, because we're not quite in the same place as America. I think the Americans are pretty comfortable. They've peaked out and going down next year. Australia, I'm not getting, it's still a little bit hazy. And I think the market's still waiting. So again, I'm not saying it's booming out there or anything like that. It's still very tight, and but I'm expecting and waiting for the break to come off.
Yeah, and I think the whole point of the show is obviously to focus on what the market has priced in and then what obviously it hasn't. And I think the question with these macroeconomic results, yes, they are bad, but someone can then argue how far ahead is the market already looking? Have they already looked past it? So how far do you think the market in Australia is looking ahead? 12 months, 6 months?
Well, I'd say 6 months for the moment in a general vibe, because I feel like the market is expecting the rates to peak next year, sometime mid next year. It's just a question how soon and how quickly they might go down. That's it with a broad brush. And then if you're watching this, you have to decide too what time frame you want to work on. So, for example, if you talk about retail stocks, they're definitely down in the dumps. Now, you could make a legitimate case to start accumulating those on the assumption that somewhere down the line things will get better. But you might have to wait for quite a while they just trend along and don't do much. So if you're chasing momentum, well, you may not find it in retail, unless it's Temple & Webster, anytime soon. But again, it comes down to time frames. So I think the small cap market, generally speaking, can be driven in the short term when the momentum and the volume is there. But at the moment, if you're prepared to take a longer term view, there's some really exciting opportunities.
And maybe I'd ask a question. What is your sort of process as a small cap investor? Where do you start? Sort of how do you make your decisions about which industry to focus on in the small cap? Or do you focus on maybe particular metrics? Maybe you look at and filter through for stocks that are low PE, or what's your process?
No, I mean, low PE, high PEs, they can be a bit of a trap. Generally, I will, because I'm just constantly reading type of thing, right? So I'll get interested in one particular sector, whether it's oil or retail, or you name it, gold. And then I'll go, okay, well, what are my candidates in this particular sector? And then I just start going through the names and, okay, what's the market cap there? Or, how old is this one and when it's been around? So I narrow it down that way, and then I'll go back and look at the history of the company and what they said they would do, and if the guys have been there for a long time and if they've been successful before. And you just start to build up a picture of what's going on. And then most importantly, when you do that sort of background stuff, you get an idea of what might be coming up ahead, because often companies will flag things in their reports or in their annual reports about what they're going to do. But unless you get off your backside and go and do it, you won't know it's coming up. So there was a good example earlier in the year with a company called Virgin Money. And I remember reading their stuff, which is slightly bigger than a regular small cap, but I was just reading about it. And they had this particular stress test that they had to pass in the mid-year that the Bank of England was going to do on them. And I was looking at the valuation, and everything suggested they would pass. And anyway, when they did pass, the stock shot up in that particular period, got a bit of a trade away on it. So it's just stuff like that where you just keeping an eye for making sure it's credible and it's got money and a business plan in place. But with small caps, obviously it's growth and what can drive them higher and what have you, whether it's market share or revenue growth. But they can come from anywhere. And so, for example, you alluded to it a little bit earlier, you've got to be aware of what's going on in the wider world. So in this case, iron ore is moving up. Well, what are the iron ore stocks doing? So, and I've done the homework there, so that's interesting right now.
Yeah. Well, I've got some other questions that I wanted to raise, but you've mentioned iron ore, so maybe we can talk about that. Last week, iron ore hit I think a 9-month high. It's crossed about 130 USD a ton. It's currently hovering around there or just below. And you've been very bullish on iron ore this whole year. So you've, I think, been one of the few who didn't expect iron ore to fall. So maybe you can explain to us why has iron ore been so resilient, and where do you see it going, and what does it mean for iron ore adjacent stocks?
Well, iron ore is a pet subject of mine because not many people talk about it anymore. It's just sort of taken for granted that it's there. But funnily enough, most of the profits in the mining industry come from iron ore. But everybody wants to hear about lithium and nickel and all that sort of stuff. So we talked about cash flows before. So a lot of those plays that people with the battery stuff don't make money. Anyway, so that's the first thing. There's also a shift going on with iron ore towards what they call green steel, so decarbonisation, which is a major trend. So again, that's an idea where you go, well, how can we play decarbonisation? and iron ore and steel are one way to do that. So generally iron ore is obviously associated with China and Chinese property. So a lot of the analysts thought, well, if Chinese property is in the dumps, well, iron ore will go in the dumps. And that was looking like it was actually going to play out in about August. But what happened, or what has been happening, is that the Chinese central bank has just started pumping in lots of money into their market. And there's a very tight correlation. And I got a guy called Michael Howe to actually do it for me. He sent me the chart, and I've got it somewhere if everybody wants to see it. But when the Chinese bank stimulates, it takes up iron ore and it takes up copper and most of the commodities. So that gave me the confidence to come out and say, hey, you got to be paying attention to what's going on in China. Then there was some subsidiary stuff of the Chinese government stepping in to basically backstop the property sector and the developers and stuff. So that's obviously very helpful for confidence. And the steel mills, etc., had low inventories and that type of thing. So I'd seen this playbook before, right? Because I remember, and again, your show is called What's Not Priced In.
Yes.
You got to remember, everybody expected iron ore to go down, right? And then China was looking wobbly. So that was what was priced in. And then then the central banks was coming in to pump it up. And I'm like, iron ore's going up when nobody thought it was going. It's not priced in, right? So get on the iron ore stocks. So that's been working lately. But I'd been through this in 2021 actually, when iron ore spiked up to over 200. So again, I knew which stocks that I liked, and I'd done the homework, and because it's people think, oh, iron ore, it's just this generic thing, but there's actually different grades and different types, and someone would say it's overly complicated, but it's not as simple as everybody says. Remember Shay Russell, my old mate, he used to go, red dirt kind of thing. So it is red dirt, but it's very valuable red dirt. And so for me, again, the beauty with the iron ore stocks, if they're producing, is as soon as iron ore goes up, they're just more cash flows start pumping through the thing. And like Fortescue just like ripped up like 30% at one point, something like that, because it just makes so much money. Printing and cash, the dividend yield was already huge. So Twiggy Forrest is loving life. But so that's a great example of something not being priced in and getting a big shift in the market in a reasonably short time frame when the market goes, oh, hey, we've got to reprice this.
Yeah. Well, I think maybe switching from iron ore to another favourite commodity in Australia, which is coal. I wanted maybe to get your thoughts on that. I was looking at some of the cheapest stocks on the ASX in last week, and a lot of them were coal stocks like Whitehaven and New Hope. And I think that can also be a trap, because usually when coal stocks are trading at such low levels, it means that earnings are assumed to be at the peak. So is that what you think is happening? What's the market pricing in? And is there value? Is that a value trap?
I have to hesitate and defer that one to Greg, because I have not traded coal and I don't know enough about it, and that keeps me away from it. I know he did a ripping call on Whitehaven and that type of thing. Look, they look cheap. I generally go along with the idea that there's no new supply coming online, so the price will be elevated. But I have to be honest, I don't know enough about it to be confident whether they're cheap or good buys or not. But if I was to see them, I do watch it. I have a list of them. And as you say, like Whitehaven, it makes a lot of money. If I saw, as a momentum play, if I saw it start to move up, well, then I'd have the confidence to maybe jump on board. But it would be more like a momentum trade rather than an investment value kind of thing, because I just don't know enough about it.
Yep. And what about lithium? Lithium, I think, is a favorite of mine, because when I just joined Fatel, I think it was peak lithium mania, and it was just interesting to be a part of and see where it started to where it is now. I think the most shorted stock on the ASX at the moment is Pilbara Minerals, with a bit 20% short interest. The third most is Core Lithium, I think over 10%. And then in the top 10 is also Sayona Mining. Lake Resources was a very popular stock, I think one of the best performing in 2021. It's now fallen about 90% this year alone. So the market sentiment has completely shifted. I think it was just one of the most illustrative lessons for me when I just first started, that you really have to be careful of the hype and just pay attention to the capital cycle. So what do you make of the lithium sector? Because I think you followed the battery metals for a while as well.
Well, yeah, man. I remember with Terence, we wrote a report back in 2015, if you can believe that, called Electric Gold.
Yep.
And that was just when Elon Musk was doing his first gigafactory in Nevada.
Yeah.
Now, this is going back, well, this is like when Pilbara was like 1 cent or something ridiculous. Anyway, so I've seen this rodeo a few times. It spikes up in 2016, 17. The stocks got dumped into 2019. 2020, they ripped up. By 2021, the lithium sector had gone like completely over the top. It went way beyond whatever I thought. So you mentioned like core lithium, that type of thing. Those developers, they're on crazy valuations. So there had to be some adjustment. It took way longer than I thought to happen, but they had to come down. I tend to tee off Mr. Lithium, Joe Laurie or whatever his name is. He's been around since I started following the story, and he's generally been okay. He says at the moment that, the price is coming down, but the long-term trend is still there. So again, it points to this idea, if you do believe in the lithium story, well, then the market is giving you a look at the stocks cheaply now, but are you prepared to wait until it all turns around again? So it might take a while. So I'm excited that it's all going down again, actually, because as you say, like Pilbara, when it's going full tilt, it makes a lot of money. So
were you surprised by how just sheer short interest? I was shocked. 20% is massive.
Well, I mean, it does seem a lot, but it's working for them. I mean, it's going down. So they'll keep running it until... but again, there might be an opportunity there because at some point they've got to get out, right? So it might have a little rally at some point. But no, I'm watching the lithium stuff because I think I do go along with the idea that there's not enough of it long term, and this is just all the... Look at iron ore. In 2021, it went over 200 a ton. Then they all get spanked for a while. Everybody gets paranoid about China. US going into recession. Now we're going up again. So you got to decide: are you in the momentum thing? You have 6 months, or are you in for 5, 10 years kind of thing?
And is your investment horizon usually over 3 years, over 2 years?
With Australian Small Cap Investigator, we look at 1 to 2 years. So that's why I'm getting interested in start kicking over some of the lithium stuff. And if you speak to the guys in mining, like my mate Headley, who does the junior stuff, like they're still interested in lithium. So yeah, it's coming down for a bit, but it's not so crazy.
Yeah, and I think with the lithium ones, it probably pays to pay more attention to the ones who are efficient producers. I think with the speculative end of the market, it's Wild West.
It is funny how the narrative changed. Like 2020, everybody's going to be driving an electric car, and now they're like, oh well, electric cars are, maybe they're not making as many sales as we thought, and Elon Musk is crazy. The whole thing's changed, but I'm sure it'll come around again.
Which actually reminds me of an interesting quote. You're a big reader, and we might get to some book recommendations at the end of the episode. But you recently read the Psychology of Money, which is a great book, and there was a quote there which I think maybe encapsulates your view at the moment. And the quote from that book is, "Pessimism isn't just more common than optimism. It also sounds smarter. It's intellectually captivating, and it's paid more attention than optimism, which is often viewed as being oblivious to risk." And I think
that's the author, by the way.
That's not Callum Newman, although you do write as well. But I do think at the moment there is this pessimism, and pessimism does sound smarter. But like you said, you probably make the most gains when you are optimistic about the long-term view. Would you agree?
Well, I'll put it like this. I started here in 2012. Pretty soon I was working with a guy called Phil Anderson. He came out and said, at that time everyone was worried about Chinese ghost cities, the pigs falling apart. The US was secular stagnation, all that type of stuff. He said, don't listen to those guys. It's crazy. There's a massive boom coming. US stocks went up 11%, 10 years, basically 10 years in a row kind of thing. Aussie property booms. You had Afterpay, you had Bitcoin, you had Nvidia. I mean, you had the social media, Amazon. My friend Chris Mayer wrote a book called
100 Baggers.
100 Baggers. Thank you. I'd almost forgot. And he talks about Amazon in that book with his analyst, and they're like, oh yeah, it's like 2014 the book came out, right? Oh yeah, we think Amazon's a buy. It makes all this money, but it kind of reinvested. Doesn't have free cash flow. But there's sort of like a doubt in what they're writing, right? Like 4 years later, Amazon was like the greatest company in the world. It's like, this stuff isn't obvious. So, but the whole time, there's always macro stuff and people gibbering on about, there's always doomers coming out and the old boys, it's going to be a big bear market and yada, yada, yada. Well, they're right some of the time, but most of the time, market goes up.
Yeah. And I think with that macroeconomic stuff is, if you're investing in a company that's really mature, then its growth is probably correlated with the wider growth of the economy. So it makes sense then to pay attention. But with small caps and usually with stocks that you want to chase the biggest gains, those companies are growing way faster than the wider economy.
Well, just look at NVIDIA. It's a 30-year-old company and it's never been better. It's just insane how much money that company makes. So who cares what the US is doing in general when if you own NVIDIA, well, you're happy as Larry.
Yeah, so if your companies are outpacing the economy's growth, then it doesn't really matter whether the US is entering a recession or not. But to be faithful to my promise to grill you.
Yeah, grill me some more. Come on.
There is something that Greg wanted to raise, which was about the very thin equity premiums in Australia and pretty much in the US as well. So, and I think it sort of ties in nicely to an episode Greg did with asset manager called Romano Salatena. I don't know if you follow him.
I know him. Yep, I like him.
Yep. It's a great episode, so do check it out. Anyway, so they were talking about the equity risk premium, how low it is in Australia. And I just did some basic numbers, so we can just use the risk-free rate, which is just the Aussie 10-year bond yield. The bond yield is about 4.4%. The ASX 200 earnings yield is about 5.8%. So the equity risk premium is just about 1.4%, and that's historically very low. And I think a few months ago when that episode came out with Greg and Romano, they were both surprised that the Aussie market is still so strong given the equity risk premium is so low. So the question to you is, how can stocks continue to rise in an environment where the equity risk premium is so low and the risk-free rate is so high? So are you betting on bond yields falling sharply, which in that case, the counter-argument would be, if bond yields fall sharply, it's usually because the economy is slowing down drastically, and that's why it sort of leads to the Reserve Bank lowering interest rates.
To be honest, I'm going to say I don't really give a toss about any of that stuff. And the reason I say that is, especially with the small cap sector, you invest in the company, right?
Yep.
You can't control any of that. I mean, that premium will jump around.
Yeah.
And I understand, especially if you're a fund manager, you do need to have a sense of how much you're allocating of your thing and your risk weightings and all that type of thing. But as an individual investor, who I cater to, and the guys running their super fund and all that type of thing, if I think this is a good company, well, you're backing its management and its business plan to achieve something. And the equity risk premium usually doesn't come into that. So I'll give you an example. Warren Ebert is a fund manager, and a property fund manager that I know, and a lot of the analysts in the property sector will go, well, the REITs, they yield 7% and the bond is 5%, and there's a 2% difference, and normally it's 3% or something. And he said just once when I did an interview with him actually, and he goes, well, I'm a property fund. I'm not going to go and buy bonds. It's irrelevant to him. He wants to find a really good property that he can do up and get higher rents and all that type of thing. So I'm not saying it's totally irrelevant, but I'm saying the name of the game is to find a great company. That kind of thing is, you can wrap yourself up in all that macro stuff, and it's, again, if you're on NVIDIA, who cares?
So that's the answer to Greg. If you're watching it, Callum doesn't give a toss. That's the quote for the clip. Okay, great. That's a nice response. But now, obviously, you've talked about the small cap sector. You do think that's probably the one that's going to maybe grow the most when things sort of improve. So maybe I wanted to talk to you about some of the stocks that are on your watch list that you're sort of keenly looking at. And there's some from in the iron ore sector. There's a US fund manager. There's a construction real estate company. And there's also, I think, a non-bank lender. So maybe we can start with MGX.
MGX. So iron ore miner. Again, driven down into August, forgotten about, nobody cares about it. But why do I like it? Well, again, nobody thought iron ore would be $130 at this time of year, US dollars, which is more in Aussie dollars. So they're just making serious amounts of money every quarter, right?
Yep.
Just crazy amounts of money. Now, it's not without risk. Don't let me say that. It's a single operation miner. So that's always a risk. Of if there's a production problem or whatever, then that's a problem. If iron ore tanks, obviously, it's going to have a big problem. But I went back, again, I followed it for a long time, over their mine plan that they're in now started actually in 2017. That's how long they've been trying to get to this, where they're at now. They are in the sweet spot of their mine plan because they had to get rid of a lot of overburden and rehabilitate what had been there before, kind of thing, to get to where it's a high grade ore miner. Again, we talked about green steel before, right? So high grade ore. They're right now in the sweet spot of their mine where they're going to have the best access to the best bit of ore, ship it out more than they have in the last couple of years. At the same time, the price is going up, and they're just minting money. But remember, it's been sold way down from all the dramas over the last couple of years. So you just go, man, this thing is literally on the floor. You're basically almost buying cash and the inventory and the mine, and you get a free option on what happens next. So again, because they're printing so much, or not printing it, they're creating it with their shipping it out of ore. When in their next results, they're going to have say, well, do we buy back stock? Do we have a massive dividend? Do we buy another? Again, because they're a single operation that has a life limit on it, they can go and buy up whatever project that they want. So they have, just because they're making so much money, they have this suite of options in front of them. And as long as iron ore stays up here, they're just going to keep making more and more money. So when I look at it, I go, well, you've got a stock that's had so much bad news hammered into it. At the same time, it's actually going really well. Why wouldn't you give it a crack?
So why do you think the market is still sort of undervaluing it? Is the market sort of betting that it's unsustainable for iron ore prices to be this high?
Could be, absolutely. Remember too that the junior market, the resource market, is, as you alluded to before, narrative driven. So if there was some whiz-bang tech that we could pin to iron ore, it's a little bit like coal, in fact, that they're not perceived to be growth industries.
Yep.
So I'm not saying either that this is one that you hold for 10 years or anything. I'm just saying that it's been so hammered and it's making so much money, I think it's going to shift up. And then you just ride along as long as iron ore holds up. And if it doesn't, well, you just jump ship. But at the moment, again, with the small cap sector, the market is not chasing stocks that aren't profitable. So we have a stock here making a lot of money,
profitable,
and I think there's value there.
All right. Well, let's move on to a US fund manager, which is listed in Australia, which is GQG.
Yes, another one, again, IPO'd a couple of years ago, pretty much went down straight ever since. I think. There's been a few of those, but again, caught up in the small cap bear market, as it were. And we did the speech at the Fat Tail event, and I gave that one to the guys. It's already shifted up in the last little bit. So in that case, it's what I believe. We talked before in the small cap sector how there's credible teams running credible businesses, trading cheaply. And that's one that fits that bill. Now, it may not be the next Afterpay and you're going to make 10,000%, but a few weeks ago it was yielding like 11% in Aussie dollars. And you were buying at less than the IPO price when they have more funds under management than they did then. Now, I have the view, which could be wrong, that the US stock market is going to keep going up for a couple of years. So they have the platform to keep aggregating more money under their assets under management, which how it drives most of their revenue, right? So again, you're just getting a look at a fairly valued or cheaply valued stock with a good team, while the bear market goes on, and you can have a look at it now and bank the dividend, see how they go.
Yeah, and I think with the small cap sector, definitely seems to be a lot more market inefficiency. So the higher you go in terms of market cap, the less inefficiencies there are because there's more analysts sort of reporting and more journalists.
Yes.
It seems with these stocks like the iron ore miner and GQG, it seems like there is a bit of an inefficiency there that may, with time, get smoothed over. Yeah.
And again, as I say, it's hard for me to get across. There's not a lot of volume in the small cap sector at the moment. It's just a lack of interest, a lack of sentiment, a lack of volume, a lack of everything. So again, but if those things come back, that's when these sort of things can start lifting, right? And again, if they're profitable and making money, if that doesn't happen, eventually they can just say, well, we'll just buy it back ourselves. So you sort of keep an eye on that sort of thing as well. So again, there's just so much opportunity. It's more ideas than you can back, really.
Yeah, and I've sort of noticed that as well in fund managers that are following Australia. They do sort of say that they are seeing a lot more opportunities these days and a lot of mispricing. So
and remember, you talked about the growth rate.
Yeah.
And so those bigger firms that are tied to that more tightly, well, if a fund manager is looking for growth, he's going to have to start look down the small cap. But also true that often those companies can be too small for the really big fund managers. They just can't get a decent size in it. So it is true that the independent investor has a better crack at some of the small cap than a bigger fund. And there's no bigger than Warren Buffett, right? And he'll go, well, I can only buy like 100 stocks in the world, right? Because I've just got too much money.
Yeah.
So you just got a suite of options that even some so-called flash fund managers can't do.
And I think Buffett was sort of saying if he had way less money, he would make better returns.
Better returns, yeah, of course. Yeah. He's too rich.
He's too rich. That's the problem he has.
He's also too old. not to do his job, but his mate just kicked the bucket. So.
Yeah. Well, he's Charlie Munger, obviously passed away. Well, we might get to talk about him later on in the show. But another stock you wanted to mention is Resimac. And I think that's also maybe a stock that's vastly undervalued by the market.
Well, I flagged that one just as an example that, again, you go back to your show, What's Not Priced In.
Mm-hmm. Not prices, right?
Last year, there was a genuine fear that Aussie property was going to crash, right? That the fund and the mortgage cliffed and the too many rate rises. So Resimac is a non-bank mortgage lender, majority mortgage. So it and its friends, whom I won't mention, inside joke, have been smashed.
Yeah.
Absolutely smashed. But it's been a business that's been around for 10 years or more. The guy who runs it's been doing it a while. It's a solid team, profitable business, just absolutely hammered. And then you go, well, what's actually happened? Well, Aussie property didn't crash. It went down a bit, and now it's sort of trending up again. Credit growth has gone from 9% to about 5%, so it's still positive. The other thing is that with that sector is they're actually at a regulatory disadvantage because the big banks got a 3-year cheap funding deal with the RBA. So that actually makes the non-banks non-competitive on price or more non-competitive. That rolls off next year in June. Now, things should equalise in. So on their asset side, everyone was worried that the bad debts would go up. Things are holding up. So that's pretty good. Then you go, well, okay, they've got problems competing with the banks in the short term on the prime side, but that will even out a little bit, although the banks will probably dominate that market still. But there's still what they call the non-prime sector, so like self-employed people and modestly impaired credit history, that type of thing. They can also pivot into asset finance, car loans, which is basically being conceded to the non-bank sector. So the big banks are like, well, we're not interested in this sector. The other guys can just fight over it. So they do have another growth lever to pull. Now, at the moment, it's not working. That whole sector, it's cheap. We can say it's cheap.
But it can get cheaper.
It can get cheaper. But my idea with that one is you have an opportunity to buy an established business, profitable business, in a niche, a select niche that's a growing market. If you're prepared to be patient, now the PE is being compressed down to like 5. That only needs to go to 10 and you're going to get a good return. But they still have a chance to grow their earnings type of thing. So with big migration coming in, car sales, more home loans, that type of thing, it is still a growing market. So that's an example where you get a look at a stock that's been absolutely hammered to the floor. You step in, you don't have to go big on it, just start with a little bit. But in 2 or 3 years, is it going to still be on the floor? Well, I'd say probably not. But again, it's the kind of one where you have to be patient. But pays a dividend. Get a look at it, see, and just follow what happens with property, car sales, credit growth. Those things, again, still positive.
Yeah. And I think maybe a disadvantage for those type of stocks is they are profitable, but maybe the market, because we've mentioned the small cap sector is driven by narratives a lot of the time. These stocks may look a bit boring or a bit unsexy, and people in the small cap sector just focus on
Absolutely
lithium or something.
And I should say, look, I've pushed the barrier for this non-bank sector to learn about it, and it never catches the eye of the herd. And again, you have to know what type of investor you are. But if you're comfortable or more comfortable with established business doing something real and making money, as opposed to some certain stocks that are more airy-fairy, but maybe going up in price, just depends on your personal style. But as I see it, there's a real business there fulfilling a real need, profitable, and I'm excited to see how they can build back up.
Yeah, and I think something that sort of confirms what you were saying about that company maybe expanding into car loans or something. There was
asset finance is
there was another lender called Plenty.
Plenty just did the deal with NAB.
Exactly,
and took off like a rocket.
Yep, went up about 100.
Now there was speculation that some non-banks would be taken over. So I read because they're so cheap.
Yeah.
Hasn't happened yet, but Plenty got the boost from the deal. But there are other stocks that are pushing into the commercial property market, business financing, self-managed super fund. So there is a niche there that companies are chasing. Public investors don't seem to care about it, but that's what I say. I do think it is an area of interest.
And I think with the big banks, them sort of the mortgage wars are so tightly fought that they might actually just look into acquiring something that has a maybe higher margins or growth sector, like maybe auto financing. But we've talked about boring sectors and sexy sectors. So I'm going to talk about generative AI, maybe with you, and get your thoughts on that. I love dictionaries. And
you might be the only one, but yeah, okay.
And Macquarie Dictionary just had its word of the year. So the popular choice word of the year was generative AI. We've talked about Temple & Webster. Temple & Webster's latest AGM presentation mentioned that they'll actually use a lot of AI in its operations, and especially with customer service.
I think Kogan is saying that as well. I just read Kogan's one.
And so what are your thoughts on generative AI? Is this hype? Is the hype warranted? Are you even looking maybe at some AI-related stocks in the small cap sector?
Yeah, in fact...
Or is it just too crowded? Because everyone is talking about it.
I mean, it is. It's going to be one of those things, but you got to learn about it. You got to go along with it. I said earlier in the year when the US bank thing rolled over, I said, I really do think AI will drive the narrative of the market and the US market back up. I got that right, but it didn't play out in Australia. So I didn't neither, we didn't make any money out of that, except that the US market went up and Australia didn't. But no, definitely I'm following what's going on there. And I did an issue with a couple of suggestions that had AI as a base. And one of them is doing really well, which is Nuix, which has, again, got flogged for different reasons, down to like paper script almost. Like. But I remember saying to the guys, well, this actually has quite an established link to artificial intelligence. It's worth a go, and it keeps going up. It's still got it's a it's very high risk kind of thing, and it has legal issues as well. It's risky, and it hasn't resolved all of them. But at the moment, it's going up as well. So the market again is looking beyond or that legal case that they're still fighting to say that there's something going on here, and I think it may be AI that's driving that. Yeah, absolutely. Is AI hype? I mean, there's going to be hypey elements to it, but there are real...
It's warranted. Is that what you're saying?
Yeah, it's warranted. I mean, look at NVIDIA. I mean, that is the classic AI play. It's going bananas. And who knows how many fabulous ways this thing will play out, or scary ways, but it's going to impact... Well, I mentioned Virgin Money before. They just came out and said, we're taking a hit to profits in the short term because we have to defend against quantum computing, artificial intelligence, and this time it's growing so fast that we got to keep up, or we're going to get smashed. So you got to be aware of it on the bullish side and the bearish side. So absolutely, you got to follow what's going on.
And I think there was news today from Westpac. It backed invested in AI lender or something like that. So auto lender. So.
Well, absolutely. Like you turn about Resimac and that, those credit guys start using AI to scan your history and all that. They're going to be able to price your loans in all sorts of interesting ways. And so there's heaps of applications that can come through.
Yeah, and I think maybe with the Australian side in terms of AI, it's not exactly as maybe high tech. We've got Appen, which has obviously now been created, and it sort of tried to hitch its wagon to AI. It didn't really work, it didn't catch on with the market. And then we've got NextDC, but it's more of a hardware play, and they have to have massive capital injection. So
it's tricky to play here in Australia.
Well, now I said that we'll get to the fun part of the show. I know you're a big reader. Yes. I think lately you've told your readers that you've just finished a business memoir, the co-founder of Triangle.
That's a bikini company.
Yeah,
it doesn't scream relevance right now, but
the reason why I bring it up is because I know you read a lot, and maybe some viewers out there might want to get some reading recommendations. We get into the end of the year, Christmas period, so maybe we'll start with what are the best books you've read this year? The bikini memoir?
You could have given me some warning on this one. That's a tricky one. Best book that I've read this year.
Or one that stands out.
One that stands out for me is Capital Wars by Michael Howe, which is, I mentioned him a lot lately, actually. Liquidity, study of liquidity, which is going to be very important for the next couple of years, right? So he studies the global flow of money and credit. And thus far, he's been very accurate with his prediction that liquidity had bottomed out last year and was slowly turning up, and it would push up the American market, and it would push up Bitcoin, and it would push up gold. Now, all those three things are happening. What it hasn't, and again, I alluded to before, Chinese central bank stimulating the money. Who told me that? Michael Howe told us that, because he follows the credit statistics. So that's turning his insight into an actionable investment opportunity that went against what everybody thought, right? Because previous to that, the central bank hadn't been stimulating, right? That's why people thought it was going to go down. So you can follow him on his Substack. You got to pay, but I like him actually. So his book, it's pretty heavy and expensive. But if you want to know I always like to check the background of these guys and make sure that they're not talking out of their hat, as it were. But that was a good one. I like him. I wish I could. I read so much I can't even remember any of them.
I was thinking, because you did say you read a lot of business memoirs, and I've always wondered, does that help you with assessing businesses? Are there actually lessons, or is it more of just a personal?
I should say I read a lot of memoirs. I like memoirs in general. So if they happen to be business related, I go along with it. My favorite book. I'll give you my favorite book that I read every year. It's called How to Be Rich by Felix Dennis.
Every year?
Well, yeah, just every now and again I get bored and I'm like, I want to read Felix's book again. So he was a very wealthy publisher in England, loved smoking and drinking and carrying on, but he wrote a really great book called How to Be Rich, and it's about building a business actually, not investment markets, but he talks about the perils and the pitfalls of what that can bring and why money and wealth, and great wealth he's talking about, isn't always as good as everybody cracks it up to be. So that's my favourite book. Another good book to read actually is Annie Duke, Thinking in Bets.
Yep. I've heard good things about it.
Yes, Thinking in Bets, which is because, again, what's not priced in? You got to think. She's a poker player, right? You got to think. What do my opponents have and know, and what do I know and think they have, kind of thing. So the market's a bit like that. So her favourite quote that I love is the game of poker, but the investing is the same, is to make future decisions easier for yourself. So again, if you look at just use MGX as an example, where you go, how much trouble can I get into this one if it's printing money already smashed up? And all I have to do is kind of follow along with what iron ore is doing. And if iron ore looks shaky, I just cut it off, right? Well, I can't get in too much trouble there. It's when you sort of reach for something that's a bit specky and you don't know much about it, and it goes down, then you're like, why have I involved with this? Because you got to make future decisions easier for yourself. So I just try and think in those terms. What's got limited downside, lots of upside, and give it a go.
Nice. That was something. Oh yes, Charlie Munger. So obviously, sadly passed away, and a lot of people, I think, in the financial community have been commemorating him. Have you followed much of his wisdom or investing advice, or does it gel with you? Is there anything of his maybe style that resonates, or any quotes?
He doesn't actually. I like Buffett,
Mm-hmm.
but I'm not a Buffett
Fanboy.
for want of a bit of not that. I mean, he's a great
Yep.
success and all that type of thing. Charlie, I've never. I mean, I was aware of him,
Mm-hmm.
but I haven't read like Paul Charlie's Almanac and all that
All
sort
his
of
letters,
stuff.
yeah.
So I have to just say, rest in peace, Charlie. But I don't actually know that much about him, except that he was Warren's right-hand man and famous for his kind of logic.
Mm-hmm.
And, he's got some... I think one quote of his was like, at some point in your life, you just want to hit forehands all day. Like, you want to be skilled at one particular thing, and that's the way to do it. But, no, I must admit, I'm not a massive Charlie Munger fan.
And you don't have to be. Well, I actually, yes, before we wrap up, I did promise that if we get enough questions or comments, I'd wear a hat. I don't have a funny hat. Our capable producer Campbell is going to provide me a hat next episode if we do continue to get questions. I'll just wear this one for now, but it was great having you on the show. I had great fun, and I hope the viewers enjoyed as well. And any final words? What's not priced in?
Well, all I can say is don't forget, I'm the editor of Australian Small Cap Investigator.
Yes.
I really genuinely believe it's coming to a very exciting period. So give it a go is what I would suggest. Start following Fat Tail Daily if you're looking for the spread of ideas from all of us here. But I think it's really exciting the next couple of years coming up. So if you're on the fence a bit, I would say start investigating and start following what you're doing and what I'm doing. And I think this time next year it'll be a very different vibe.
Mm-hmm.
So you can book me in for this time next year and we'll see if I was right.
Okay, that's done. So get excited, look at small caps, and stay positive.
Absolutely.
See ya.